This report brought to you by the Richmond Club, where investors and high-growth companies meet.
Our next presenter is Doug Ramsey. He is the president and CEO of North Mining.
Well, again, thanks very much for everyone coming out to hear us pitch our projects today. I'm Doug Ramsey. I took on the role of CEO and president of Copper North at the beginning of 2019. I've been with the company for 7 years now, started as a vice president, and with the retirement of our previous CEO, I took on the reins to continue to move the company forward. I'm talking today about how we're transforming our flagship property, the Carmacks Copper-Gold-Silver Project, located in Yukon. And yes, I will be making forward-looking statements. If I don't, I'm not doing my job. As I said, we're focused on our Carmacks project. It's located in Yukon, and it's a high-grade oxide copper-gold-silver deposit. By high-grade, I mean close to 1.1% total copper, and it has almost 0.5 gram per ton of gold and 4.5 grams per ton of silver. It's a smaller project. It's been around for a long time. You maybe would remember it when it was held by Western Copper, and at that time it was being treated as a copper-only heap leach project. It was ignoring the precious metals that are in the ore, and the basis of our transformation in part is to change our metallurgical process to bring in those precious metals and improve the value of the project overall. At this point, as an investment opportunity, we're considerably undervalued in comparison to our enterprise value, in part because previous direction didn't do a lot to get the story out into the broader population, and didn't do a lot to support our share price. I see that as being one of the major limitations that we've had, and I'm moving very quickly to begin to change that. We have about 86 million shares issued. Of those, management and directors hold about 10%. We don't have any institutional involvement at this point, but we do have two major shareholders. One is a family in the mining business. They're based in Yukon. They hold about 1/3 of the shares. And there's a high net worth individual who has made his money in the renewable energy business in Thailand. He holds about 20%. And between that and other friends and family, about 65% of our issued shares are very closely held. We've got a very experienced team. I've been doing mining related work for the past 35 years. Our chairman, Bob McKnight, is presently a vice president at Nevada Copper, a much larger copper project in development right now. And getting back to our Carmacks project, people think Yukon, well, it's in the north, it's remote, could be remote from infrastructure, difficult to develop. Well, none of those things. Carmacks is, I can quite confidently say it's far from remote. Our site is road accessible now, and we're located 12 kilometers from grid power in Yukon. So we'll have the infrastructure both to be able to get in easily and to connect to grid power, which in 2018 was about 94% hydropower. So it's substantially a renewable energy source to power the project. And that's something that's going to be very important when it comes to attracting partners going forward. I'll move back to in the beginning. Copper North was spun out of Western Copper in 2011 with the Carmacks Project. And at that time, it was a project with very mediocre economics. This summarizes it here: 7-year mine life, 12 million tons of 1.1% copper. At that time, it was 177 million capex to put it into production, and very modest economics that came along with that. You're looking at an after-tax payback of 5 years on a 7-year mine life. So it wasn't hugely attractive at that time. The other thing is that at that time, Canada, US dollars were at par. If it was to be built today, the capex would probably be about another $20 million higher because of the lower Canadian dollar presently. So what have we been doing? Well, obviously we had to improve the economics that this project was going to go anywhere. And how have we been doing that? Well, the first thing is we want to maximize our metal recovery. Get not just copper, but also gold and some silver if we can do that. We want to see what we can do about cost of production. The heap leach project was about $1.60 a pound as a cash cost. We'd like to get down into the lower decile of the cost curve of new producers. And also, obviously, we need to expand our mineral resource so that we've got a longer mine life. So those are really the 3 legs of the stool that we've been working on building over the last few years. We have a quality deposit, and as an oxide deposit, it's pretty much unique in Canada. We don't have oxide deposits for the most part because we're heavily glaciated. The glaciers scrubbed the oxide off a long time ago. The Carmacks Project is in Beringia in Yukon, so it was not subject to the last glaciation. So we've got up to 300 meters of oxide sitting near surface that is an open pitable resource. Plus we're in Yukon, we're a scenic 3-hour drive north of Whitehorse now, in a very mining friendly jurisdiction. The number one focus of the Yukon government for economic development is mining. So what did we do to maximize metal recovery? That was one of the first things we looked at. Back of the envelope calculation is by bringing the gold into the model, we should have added about 30% to our net revenue. Well, then we just needed to figure out how to do it. And it turned out to be relatively straightforward. By adding a grinding step after crushing, it gives us a slurry we can pump instead of having to heap leach, and we can leach it in tanks. So we moved to a 2-stage agitated tank leach process. The first stage allows us to leach the copper, and because it's an oxide, we're leaching it, and then we can take the leached copper and produce cathode copper on site. So we're not producing a concentrate, we're producing copper cathode that can be sold directly to an end user. Among other things, it reduces our costs of shipping the product, because instead of shipping 25% concentrate, we're shipping 99.99% copper. The other thing about the 2-stage process is it allows us to, in the second stage, recover gold and some silver by cyanide leaching. So copper's leached in the first stage. That leach slurry is rinsed and neutralized, and then goes through a second series of agitated tanks for leaching gold and some silver with cyanide. The leached precious metals go off to a carbon and leach plant to produce a gold doré bar. Then the barren slurry is treated for cyanide destruction using the Inco SO2 process, and then we're filtering the tailings for dry stack tailings placement at the end. So we're producing cathode metal on site, we're producing gold and silver doré bar, and we're using best available technology for tailings management at the end of it all. The agitated tank process is very efficient. We're effectively getting 100% of the acid-soluble copper in the ore. And our recovery of the cyanide leachable gold is almost as good, but the key part of it is getting all of the acid leachable copper in the first stage. So what does that give us as far as project economics? Well, it actually increased our net project revenue by 73%, and that is, and I'm using 320 copper here and 1320 gold. The 320 copper allows us to make a direct comparison to the former heap leach project. It was within the range of the sensitivity analysis on our study, but I wanted to just present it at 320 so we can do an apples to apples comparison of what we had before and what we have now. But the other real key benefit is that our cash cost of copper production after our precious metal credits drops from $1.59 a pound for the copper-only heap leach project to $1.08 a pound for the two-stage agitated tank leach project. That takes us into the lower decile of the cost curve for projects that are expected to come online in the next 5 to 7 years. That's what part of the process plant will look like. If there are questions about it, I can answer those later. It's a small-ish mine site, but it's almost ideal for development of this project because we don't have to haul waste rock very far, we don't have to haul our ore very far to the process plant, and that helps to keep our operating costs down. Now, in this table, I'll call attention to this first column and this last column. First column is what the heap leach project economics were. Last column is the apples to apples comparison at the same copper price, but with the addition of the gold and silver recovery. So at that point, it's still based on a 7-year mine life, same annual copper production, same copper price, but we've increased our gross revenue from $677 million to over $1 billion. Our net revenue is up about 73%. Our cash cost is down significantly. Net present value is up. IRR is up. And our payback, even though we're spending 38% more on CapEx, our payback period has been dropped. And that's just with the 7-year resource. And that summarizes the same thing. Next part of it is expanding the mineral resource. We've drilled in 2015 and 2017. We're focusing on known mineralized zones that have not been drilled before. And our initial objectives are to add another 3 to 4 years of an oxide resource. So basically a 50% increase in our on-site resource. And the other part of it is we're also looking to further delineate the sulfide that's sitting underneath, because that's Carmacks 2.0 basically. We're in one of the best places in Western Canada to be looking for copper because that's our project there, and we all know that grade is king. So that's what our grade is now, and that's what our neighbor just up the road, Minto, mines. As I mentioned, we're focused on known mineralized areas. That zones 1, 4, and 7, that's what the 7-year mine life is based on. Most of our 2015 and 2017 drilling was down to the south in zones 12, 13, and 2000 south. We get immediate visual feedback on what we have in our drill core. This just showing our oxides of malachite, azurite, and it doesn't show very well, but there's also some tenorite in there. In 2015, we increased our oxide measured and indicated resource by 31% on the site. We increased our sulfide resource by 85%. And the total increase was a 62% increase over what we had previously. 2017 drilling added to that further. At this point, we've found about 2.5 years of additional mill feed. So it's not a 7-year mine life anymore, it's now up to 9.5. And we aren't finished with our exploration. To give you a sense of what it looks like in a 3D oblique view, 7-year mine life is based on the oxide here. This is what we added in 2015 and 2017. Sulfide sits underneath, and entirely along that 2.7 kilometer strike length, the sulfide is open at depth. We don't know where the bottom of it is. And the only thing we know is, as far as how grade varies across the site, as we go south, the grade gets lower. And so the next phase of our exploration will take us to the north, where we know that grade increases because, and likely will increase continuing from Carmacks all the way to Minto, because the Minto is north of us, and that's where the even higher grade was found. And this summarizes the sulfide mineralization. And just in summary, this is the value that we've added so far. It's part of our progressive our transformation, I should say. And I'll just take you down to the bottom for a second, and on the environmental sustainability side. We're building that in as a core design criterion for all of our project. The green energy metal buyers want a sustainably produced metal source. And with cathode being produced with 94% renewable energy, there also is a wind-powered development possibility on top of that. It may be the only copper mine in the world that can produce cathode copper on-site with 100% renewable energy. What are the next steps? We need to move our process up to feasibility engineering to match the rest of our project. That allows us to get back into permitting, and at the same time we can begin talking to potential partners about cathode copper offtake opportunities to move the project forward. If all of the financing was in place today, we could be producing copper in 3.5 years. So, summary of strengths. It's an advanced stage, 3.5 years to production. We're already partly permitted for construction. We've got a feasibility level resource, mine plan, and infrastructure plan. We just need to bring our process up. Low-cost copper producer, bottom decile of future producers. We have excellent infrastructure. We're largely unencumbered, just a small advance royalty that we're paying off at $100,000 a year. We've got the Canadian dollar exposure, so our expenses are in Canadian dollars, whereas we're paid in US dollars. There's the environmental sustainability aspect, and we're in an ideal position to take advantage of the looming copper supply shortfall and the expected price increases that come from that. Also in a position for re-rating as our de-risking project continues. There remains potential for future resource growth, and as far as the economics that we're reporting, we still need to bring those other 2.5 years of resource into our economic model. So keep in mind that the economics you were seeing is based on a 7-year mine life, even though we've added another 2.5.
If you've enjoyed this video, please let us know. You've been watching the Richmond Club Report. If you've just come across this channel, please feel free to subscribe. I'm sure you'll find a lot of interesting and profitable investment ideas around here. We'll see you again soon on the next video. Cheers, guys. Have an amazing and profitable day.